You know what kills most trading strategies? It's not bad entries. It's not poor risk management. It's not even lack of discipline. It's something way more fundamental. They're built for one type of market. And the second that market changes, the strategy breaks. Completely. You've seen this happen. Maybe you've lived it. You find something that works. Backtest looks beautiful. Forward testing starts strong. 3 months of consistent profits. You're thinking you've finally cracked it. You found your edge. Then the market shifts. Volatility spikes. Or it dies. Trends turn into chop. Breakouts start failing. And suddenly, your beautiful strategy that was printing money is bleeding it away. Same rules. Same execution. Different results. And you're left wondering what the hell happened. Here's what happened. You built a strategy for a market condition, not for the market. And the market doesn't stay in one condition. Ever. It cycles. Trending, ranging, volatile, quiet, risk on, risk off. It moves through these phases like seasons, inevitable, unstoppable, completely indifferent to your strategy. Most traders respond to this in one of two ways. Either they abandon the strategy completely and go hunting for the next one that fits the current market, or they hold on stubbornly, taking loss after loss, convinced it'll start working again if they just stay disciplined. Both approaches fail. The strategy hopper never builds real expertise. They're always starting over, always learning a new system, always 3 months away from consistency. The stubborn trader slowly bleeds out, watching their account shrink while they wait for conditions that might not return for months. There's a third option. Build a strategy that doesn't depend on market conditions, staying the same. Build something that adapts, that survives, that works in trending markets and choppy ones. In high volatility and low, not equally well in all conditions. That's impossible. But well enough to stay profitable through the full cycle. Let's talk about how to actually do that. Because it's not what most people think. Most people hear adaptable strategy and they think complicated. They think multiple systems, dozens of indicators, complex rules for switching between modes. They think they need to become some kind of market condition expert who can perfectly identify when to use which approach. That's not it. That's just more ways to be wrong. Real adaptability isn't about complexity. It's about building flexibility into your foundation. It's about accepting certain truths about markets that never change, even when everything else does. Here's the first truth. Every market condition favors certain behaviors and punishes others. Trending markets reward patience and position holding. They punish quick profit taking. Choppy markets reward quick scalping and range trading. They punish holding for big moves. High volatility rewards wider stops and smaller position sizes. It punishes tight risk parameters. You can't fight this. You can't force a breakout strategy to work in a range-bound market just because that's what you know. The market doesn't care what you know. It does what it does. So, your strategy needs to acknowledge this reality and build around it. Not by trying to be perfect in every condition, but by avoiding catastrophic failure in any condition. Think about it differently. You don't need a strategy that makes 20% in every market cycle. You need one that makes 15% in favorable conditions, breaks even in neutral ones, and only loses 5% in unfavorable ones. That's survival. That's sustainability. That's what compounds over years. But here's where traders mess this up. They optimize for maximum performance in one condition, then act surprised when other conditions destroy them. They backtest their breakout system on 2023 data when everything was trending, then wonder why it fails in 2024 when the market turns choppy. They're testing for best case, not worst case. They're building for performance, not survival. Flip that script, start with survival. Build a strategy that first and foremost doesn't blow up. Then, optimize for performance within that constraint. Because a strategy that makes 30% in good markets, but loses 40% in bad ones isn't a strategy. It's a gamble. And you're not here to gamble. You're here to consistently extract money from the market over time. So, what does a survival-first strategy actually look like? Let's break it down piece by piece. First, you need multiple ways to make money, not multiple strategies. Multiple edges within one framework. This is crucial. If your only edge is catching momentum breakouts, you're dead in choppy markets. If your only edge is range trading, you're dead in trending markets. But if your framework allows you to trade breakouts when structure is clean and ranges when it's messy, now you have flexibility. Same core principles, different applications. Here's an example. Your framework might be trading order blocks and liquidity grabs. That's your foundation. In a trending market, you're looking for pullbacks to order blocks in the direction of the trend. You're patient. You're holding for extensions. In a choppy market, you're looking for liquidity grabs at range extremes. You're quick. You're taking profit at the opposing side of the range. Same concepts. Order blocks and liquidity. Different execution based on what the market's giving you. You're not switching strategies. You're adapting application. That's the difference. Your edge doesn't change. Your entry criteria might shift slightly. Your profit targets adjust. Your holding time varies, but you're still trading the same underlying principle. This keeps you sharp. You're not learning new systems every quarter. You're deepening your understanding of one framework across different conditions. That depth is what creates long-term profitability. But here's the part nobody wants to hear. You also need to accept that sometimes the best trade is no trade. Sometimes market conditions are so unfavorable for your approach that the right move is to step aside, not forever, not giving up, just recognizing that not every market cycle is yours to trade. This is where most traders rebel. They think sitting out means they're not real traders. They think they should be able to make money in any condition if they're good enough. That's ego talking. That's not reality. Even the best traders have market conditions where their edge diminishes or disappears. The difference is, they recognize it. They reduce size. They trade less frequently. They preserve capital until conditions improve. They don't force it. Because forcing trades in unfavorable conditions does more damage than missing opportunity. It destroys confidence. It depletes capital. It creates bad habits that persist even when good conditions return. Think of it like a professional poker player. They don't play every hand. They fold most hands. They wait for spots where the odds favor them. They're not less of a player because they fold. They're more of one because they have the discipline to wait. Trading is the same. You're not less of a trader because you sit out a choppy month. You're demonstrating that you understand your edge and respect its limitations. Now, let's talk about position sizing because this is where strategies live or die across cycles. Most traders use fixed position sizing. 1% risk per trade or 2% or whatever their number is. Same size every trade regardless of conditions. This is insane. It's treating every trade like it has the same probability and every market condition like it has the same risk. They don't. High volatility markets can stop you out on normal noise. Choppy markets can churn your account with small losses that add up. Trending markets can run way beyond your typical targets. Your position sizing needs to reflect these realities. In volatile conditions, size down. You need wider stops to avoid getting chopped out, which means smaller positions to maintain the same dollar risk. In low volatility, you can size up slightly. Tighter stops work, giving you room for larger positions. In choppy conditions, reduce frequency and size. Your win rate drops. Your edge compresses. Protect capital. In trending conditions, this is your time. Clear structure. Better setups. Higher probability. You can be more aggressive here, not reckless. Aggressive within your rules. This isn't discretionary gambling. This is systematic adaptation. You're not guessing. You're responding to measurable conditions. Volatility is measurable. ATR tells you exactly how much the market is moving. Trend strength is measurable. ADX shows you if there's directional conviction. CHOP is measurable. Price action at support and resistance tells you if structure is holding. You can build objective rules around these measurements. When 20-day ATR is above X, reduce position size by Y%. When ADX is below Z, reduce trade frequency. When price is respecting range boundaries for N bars, shift to range trading mode. These aren't complicated. They're just acknowledgments of reality translated into action. But here's what makes this work long-term. You have to track it. You have to review not just individual trades, but how your strategy performed in different market conditions. Keep a journal that notes market condition for every trade. Trending or ranging. High vol or low. Risk on or risk off. Then review monthly. How did you do in each condition? Where was your edge strongest? Where did you struggle? This data tells you everything. It shows you which conditions to trade aggressively and which to trade carefully. It reveals your actual edge, not your imagined one. And it gives you confidence to adapt because you're not guessing anymore. You have proof. Your own trading history showing you exactly what works when. Most traders skip this part. They review individual trades, but never zoom out to see the patterns across market cycles. So, they never learn which conditions favor them. They just keep trading the same way in all conditions and wondering why results are so inconsistent. Your results are inconsistent because markets are inconsistent, but your approach to those inconsistent markets can be systematic, can be planned, can be survival-focused. Here's another piece that matters. Your strategy needs built-in circuit breakers, rules that force you to stop when things aren't working. Not based on emotion, based on metrics. For example, if you're down more than X% in a month, you reduce size by 50% for the next 20 trades. Or if you have 5 losses in a row, you pause for 48 hours and review. Or if your win rate drops below your historical average by more than Y% over Z trades, you stop taking new trades until you identify what changed. These aren't punishments. They're protection. They prevent small drawdowns from becoming account killers. They force you to recognize when something's off before it becomes catastrophic. Because here's the thing about market cycles. Sometimes your strategy stops working not because the market changed, but because you did. Your execution got sloppy. Your entry criteria drifted. Your discipline wavered. Circuit breakers catch that. They create mandatory pause points where you have to look honestly at what's happening. And often, you'll find the market didn't change. You just stopped following your rules as precisely. That awareness alone fixes most problems. But without the circuit breaker, you just keep bleeding, blaming the market, never looking inward. The strategies that survive every market cycle aren't magical. They're not complex. They're just built on principles that don't change. They're flexible in application, but rigid in foundation. They adapt position, sizing, and frequency, but not core edge. They acknowledge limitations, but don't abandon ship at first difficulty. And most importantly, they're designed to survive first, perform second. Because you can't compound profits you don't keep. You can't learn from experience you don't survive long enough to gain. The game isn't about having the best strategy. It's about having a strategy that's still there when the next favorable cycle arrives. Build for that, test for that, trade for that. Everything else is just noise.